Coming up in today's show, stocks start Thanksgiving week higher. Can the S&P 500 hit all-time highs this year? JP Morgan says the risk reward now appears unattractive. Oil continues its bounce back, and Microsoft shares hit all-time highs after hiring former OpenAI boss. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared, and we've got a shortened trading week this week thanks to Thanksgiving in the States. The markets are closed all day Thursday and just a half a day on Friday, and that can typically be a low volume, low volatility week. However, once again, that bullish momentum from last week has spilled over to this week, led by mega cap tech with Microsoft up over 2% and Nvidia up over 2.2%. They're going to be reporting earnings tomorrow afternoon. Otherwise, it was a bit checkered in breadth across the board and a little bit of a growth rotation. We actually saw utilities, consumer staples, and some healthcare stocks come off somewhat. And we actually just broke out to new year-to-date highs on the NASDAQ. We can see that on the Qs here, closing a bit above 390. That was eclipsing the previous high we made on the 19th of July, just below 388. And just taking you out to a weekly chart, that's not too far off the all-time highs we made in November 21 at 408. So believe it or not, the NASDAQ is less than 5% away from trading at all-time highs. And that's thanks to the big fella, Microsoft, breaking out. It actually closing at all-time highs today, $377 a share, now with a market cap of $2.8 trillion. And that was on the back of news of Microsoft hiring former OpenAI boss Sam Altman. That's the company that owns ChatGPT, and the board actually ousted him over the weekend in a still ongoing controversial event. And Sam's viewed as one of the AI visionaries, leading people on the topic, and it came as a shock to hear that the OpenAI board said it no longer had confidence in his ability to continue leading. And so Microsoft moved quickly to get him on board their team, even though Microsoft owns 49% of OpenAI. And now we're just hearing news that OpenAI employees threaten to quit unless the whole board resigns. That's more than 700 OpenAI workers coming to the defense of Sam. So still quite a fluid situation here, but nonetheless, investors love it anyway, with Microsoft trading a huge 52 million shares, and this thing cannot be knocked over, just keeps powering higher and higher, and is less than 200 billion away from taking the lead away from Apple as the largest stock on the market. Also helping the NASDAQ today was Nvidia, closing at all-time highs as well, above $504 a share, and a clear sign that the AI craze is still alive. And we'll get to hear from Nvidia tomorrow with their earnings, expected to come in with $3.36 per share, and the options market pricing an expected move of 7.4% either way. And they'll be reporting tomorrow after market close, and this could get the market moving. And like I've been saying, I wouldn't be surprised to see another big gap up and kind of taking a lot of people by surprise, and that once again will get the NASDAQ moving higher, along with the S&P 500 now only 60 points away from reaching new all-time highs for the year. However, that's got a little bit more work to make all-time highs above 48.18 that we saw early last year. And like I've been saying last week, my indicators, even though we're into overbought territory, they're kind of flatlining and walking the line, not really setting up any divergences here. And with this huge amount of momentum and breadth thrust in the market, it's got a lot of legs and could keep going. And I can also see that in the options market, with option dealers still showing negative volatility risk premium. That's the VIX below realized volatility. And what that basically means is option dealers are expecting more calmness in the market ahead, even more calm than what it is now. And that's typically a bullish sign for the market. And just before I get more into today's news and the charts, I wanted to tell you quickly about my Cyber Week special, where you can get up to $1,000 worth of my products and services for free simply by buying other trading tools through my links on this page here on my website, clickcapital.io. And these are 7 tools I use myself, and you'll see throughout this video, with the first and biggest one being TradingView, the number one charting platform online. And so if you don't already, I highly recommend getting a new account with TradingView, visiting it through my site here by clicking on this blue button, then taking advantage of their huge Black Friday sale, which is only for the next couple of days. You can save up to 70% off. I highly recommend getting the premium plan, only for $217 for a year, plus they throw in a free month, saving you over $500. And then if you buy that through my link, you'll get $217 worth of my products and services for free. So you may want to get some of my custom TradingView indicators for that. I've got over 22 that I've developed and use every day myself that you see throughout these videos. I also have a trading strategy that you can follow with real-time alerts called OnlyBez. That's $75 a month, so you could get a month or two free of that. And I've also got a special investment presentation where I show you the micro cap I've just recently invested in. That's for $59. So just come to my website, clickcapital.io, click on the big red banner up the top of the page, and you can look through the 7 different trading tools that I've partnered with and use myself. In addition to TradingView, there's Seeking Alpha, which in my opinion is the #1 platform for fundamental analysis. A lot of great content and research on there. Market Chameleon for options data, Simply Wall Street, which is a great simple app to analyze stocks, and others like Bar Chart, FinViz, and Trader Sync, a really cool trading journal. So if you come to this page and visit these websites by clicking on these blue buttons and purchase any of these tools, some of which are running their own Cyber Week specials, not only will you get the same benefits and same huge savings they're offering if you go there directly, you'll also get the equivalent value and free credits to spend how you wish across my site. So if you're serious about your trading and investing, I highly recommend you take advantage of this offer. I always do my buying during Cyber Week. That's when you get the biggest savings and specials. And I believe I've got the best deal out of everyone because you're going to get 100% rebate on my products and services on top of the savings from those tools. So to take advantage of that, head on over to my website, clickcapital.io. I'll put the link below the video in this description and get yourself a new trading tool and some of my products and services for a great deal this week. Okay, so just moving on through the daily show. We just had a good start for the week. And looking at the seasonality this year of annualized returns by day of the week, Monday is actually the best, coming in at a huge 70%. And we typically see a little bit of weakness midweek, Tuesday, Wednesday, and then picking up again Thursday into Friday. But remember, this is Thanksgiving week. The market's closed on Thursday, and then we've just got a half day on Friday. We close at 1 p.m. And that's typically a low volatility, low volume week, but we can get some funny moves, especially because we've got the wild card of Nvidia earnings tomorrow after close. That could get things moving either way come Wednesday open. And we're getting more and more bullish technical signs of the market, with S&P 500 just exiting correction territory. And that's thanks to retreating bond yields over the last couple of weeks. And so exiting correction territories when the market comes off all-time highs by 10% and then bounces back 10%. And we've just seen that in the past 16 days, which is the quickest period of time the S&P has emerged from correction territory, and just shows how strong this move has been from technically oversold to overbought, giving us signals like the swing breadth thrusts, which typically results in higher prices in the months ahead. And with this momentum, some are saying the S&P 500 can hit a new all-time high this year, and that's above 4,800. And that's thanks because we got some cooling inflation with the stock markets really loved. We also had Fed fund futures say that the Fed is pretty much done now. And that's kind of like the Goldilocks scenario and setup for the stock market, on top of some other things like really good Q3 earnings and the price of oil coming down, which some are saying now sets up for a good 2024. S&P 500 likely to go above 5,000 next year, in which one strategist, Phil Orlando, is saying it's the second leg of the bull market that's going to have a lot more room to run. And his optimism comes largely because he thinks the Fed is done hiking interest rates. He goes on to say the bond market's done the heavy lifting for the Fed since the last Fed rate hike in July. That gives the Fed the luxury, in my view, to step back and say, you know what, we don't have to hike anymore. We can just sit here on the sidelines for the next year and allow the gradual slowing of inflation to occur. And I'd have to agree with that. The Fed and Jay Powell would have to be pretty happy with inflation coming down and unemployment still pretty good. The economy still holding up pretty good, and that's thanks to the bond market. So while the trade this year has been the mega cap tech stocks, the Magnificent Seven significantly outperformed the rest of the market. A lot of people saying now those other beaten down sectors, small caps, dividend paying stocks, utilities, REITs, could have a chance of catching up to them now throughout the rest of the year going into next year, with also some seasonal factors at play that could help out. And that's the spread between small caps and large caps. Looking at the average seasonal pattern going back 30 years, this is where we are right now. And typically the rest of the year, small caps will outperform large caps. And just looking at a spread chart of the Russell versus the S&P 500, you can see that's really come off a lot this year. Been in a solid downtrend, however, we may have put in a bottom a week and a half ago. You can see my indicators turning positive, bullish divergences. We still are not above the 50-day VWAP yet. And just taking you out to a bigger time frame, the monthly chart of this spread over the last 10 years, that's pretty much been in a downtrend as well. Lower highs, lower lows. And so small caps have been beaten down significantly, and that's largely thanks to the Magnificent Seven significantly outperforming. And I myself prefer small caps going forward with a larger weighting. And because not only are we technically beat down versus large caps, the spread in valuations is near all-time extremes as well. In fact, we've only seen a wider spread, less than 1.7% of the time, of the earnings yield gap between small cap value and large cap growth. And typically when we see that, in the following 10 years, small cap value returns a huge 16.8% year more than large cap growth. However, not everyone's on board with that. Some analysts saying you can't even snooze during Thanksgiving week, with still the potential for an increase in volatility in the market, thanks to a lot of macro factors. However, if you look back in history, you'll never find a time when it's perfect to buy stocks, when everything is what you want. Low inflation, growing earnings, perfect charts, valuations. A lot of the times you just have to take what you can get. But that doesn't mean not paying attention to risk, because like JP Morgan says, even though the S&P 500 is exiting correction territory, they think the risk reward in stocks appears unattractive here. And that's their chief strategist, Marko Kolanovic, saying that stocks are unattractive as the Fed continues to hold interest rates at a restrictive level, going on to say falling bond yields are being interpreted by equity markets as a positive in the near term. Yet, absent preemptive rate cuts by global central banks, we see risks compounding with peak effect of restrictive monetary policy still ahead, with consensus expectations of 12% forward EPS growth, which in our view is divorced from these risks, should be revised lower. So basically what he's saying is the economy and market hasn't felt the full effects of the Fed rate hikes, and that analysts are too optimistic with their earnings growth projections next year. And it's a good point, the stock market is really trading as if there's going to be no recession, no landing, and that earnings are going to get back to growing above 10% next year. So if he's right, there could be quite the upset and sudden correction in the stock market should we see a sudden weakness in the economy. And for clues on that, you want to pay attention to the unemployment rate, which we get on the first Friday of every month, currently sitting at 3.9%. And that's now 3 consecutive months. It's above the 20-month moving average in the yellow line here. And that typically forecasts is a recession just around the corner. But according to the stock market, it is different this time. But according to Fed Fund futures, it's not different this time. They're actually given an almost 1 in 3 chance the Fed will cut come March, just a few months away, and a 63% chance they will have cut come May. Now that would have to be in response to immediate weakness in the economy for the Fed to start cutting rates, or inflation would have to absolutely melt away in the next couple of months. And a big part of that would be oil prices needing to keep on coming down. As the biggest volatile variable component in inflation, we just saw it rise for the second day in a row after being sold off really hard the last couple of weeks. We've got OPEC Plus set to meet this Sunday, and it's highly likely the Saudis and other OPEC producing nations will extend their production cuts into next year as they'd like to support the price of oil and see it a bit higher. So for clues on inflation, keep watching the price of oil. As we saw CPI tick up those couple of months that oil ticked up, and now we've seen some soft inflation prints over the last week or so with the price of oil coming down. And just taking you out to a monthly line chart on crude oil futures here, and if I just overlay that with the inflation rate year over year change, you can see that correlation between the two. And even though we got a bit of a bump up there in oil, we only saw a little bit of a bump up in the CPI, and then once again it's turned down a bit. And with those softer CPI and inflation prints, that's brought bond yields down as well, with longer dated treasury yields ending at the lowest level since late September, after we got a strong sale of 20-year government bonds today. That was a bit against the trend of late where we've been seeing some weaker auctions. And there's a look at the 20-year government bond yield at 4.78%, actually topped at 5.38% about a month ago, so there's been a huge amount of volatility in the bond market, and up the front's pulled back a bit as well with the 2-year at 4.91. So the stock market is getting excited at the prospect of rate cuts and can typically rally going into rate cuts when the Fed's on pause. But you got to remember that's a double-edged sword, because rate cuts would likely come in response to a slowing economy. And you got to remember, with near perfect track record, the stock market almost always makes its bottom after the recession has started. So whilst there's a lot of bullish momentum in the stock market right now, that may only last a few months until we see some weakness in the economy next year. And that'll typically come from a rising unemployment rate, people losing jobs, less discretionary spend going on in the economy. But for now, the stock market is ignoring that. We've still got a lot of buzz about AI, and we can see that in the price action of Nvidia, closing at the all-time high today at $504 a share. And there's big expectations for earnings tomorrow. Analysts are expecting to see huge revenue growth of over 170%, and the stock price is already up a huge 245% this year to date. And don't forget, the CEO of Nvidia, this guy here, Jensen Huang, has been selling into that strength like he typically does. We can see some big numbers coming through. Back in September, he's been selling tens of millions of dollars worth of shares, along with a bunch of other board members in September and back in June after their last big earnings beat. So if we do get another pop tomorrow afternoon, I can imagine Jensen Huang and his mates on the board will continue selling into that, because even though they've got an exciting story, product, and a lot of growth, valuations do matter in the long run, with it currently at a market cap of 1.24 trillion on trailing 12-month sales of around 28 billion. That's a huge price to sales of 44, when the S&P 500 as a whole has a price to sales of 2.5. And just looking at my stock fair value indicator. That's got it at $226 a share, saying it's currently 122% overvalued. Now, expensive can get more expensive, just like cheap can get cheaper. Markets can do crazy things in the short to medium term. However, for Nvidia to deliver investors a great return over the next 5 to 10 years from this high starting point, they would have to absolutely knock it out of the park and likely keep average annual earnings per share growth above 30%, probably more above 40% to justify this current valuation. So make sure you come back to the Click Capital channel tomorrow. We'll be paying close attention to their results and, more importantly, how the market reacts, as it could have a big knock-on effect to the NASDAQ and the S&P 500. Just looking at economic data today, real quiet week. Didn't get really much out today, and due to Thanksgiving week, we don't have a whole lot out. A little bit of inflation data from Canada on Wednesday, some housing data from the States as well. The usual weekly jobless claims come Thursday, and then a bit of inflation data out of Japan to finish the week out on Friday. There's the Fear and Greed Index ticking up again from 58 on Friday to 62 today. So the stock market's really starting to get some bullish legs here, but we're still not at that extreme greed levels where we're typically closer to a short-term top. However, we are getting towards that level. And we saw a huge uptick in corporate insiders selling stock on Friday, coming in at 294 different sales, and that's the highest level we've seen in over 6 months. So corporate insiders are selling this rip here, as they typically like to do, sell into highs, buy into lows. And just looking at my institutional buying percentage indicator, that's gone back into the neutral zone above 45%, with the S&P 500 oscillator still in an overbought zone. But like I said, it's in this dynamic now of walking the line and kind of hovering up there, which, like we saw back in June, July, can stay in that kind of area for weeks. And same with my other indicators, the buy-sell bands. If it doesn't bounce off typically straight away, it can kind of hug it and walk the line and kind of just drift higher. And I'm seeing that in my DSI as well. That's kind of just hugging up there. It's not really diverging, and same with the hidden divergence. And there's the chart of the Mega Cap 7, the Magnificent 7, breaking out to new year-to-date highs. And there we are, not too far off from making all-time highs. With the composite index all-time high at 1951, here we are at 1930, basically 1% off reaching all-time highs, that group of 7 large stocks. Looking across other markets, international stocks pretty flat to start the week as well. Not a whole lot of volatility around the world at the moment. VIX coming off again to 13.4, and pretty quiet day in the options market. Just under 35 million contracts traded, but really lopsided at 57% calls. You can see that in the put-call ratio at 0.82. And even though volatility is low on at-the-money options, out-of-the-money put options are still relatively expensive here, with the skew index at 143. And there's breadth, really kind of holding on, hovering up there. 87% of stocks above their 20-day average. There's those big breadth thrusts we can see in the amount of stocks above their 50-day average. And we've now got more than half of stocks back above their long-term average 200-day. With some improving breadth signs and new highs versus new lows, 73 to 3 on the NYSE and 69 to 20 on the NASDAQ. Another breakout in the growth versus defensive sector spread, and high beta stocks still doing a lot better than low volatility stocks. And there's another indicator of risk sentiment in the market. High yield bonds versus treasuries holding their ground pretty good above the 50-day. And that pullback in yields has helped TLT find another multi-week high here today. And it's looking more and more like this is at least a short medium-term bottom in the bond market back in mid-late October. Also helping stocks is a weaker dollar, falling again today. Now just a bit above 103. There's Bitcoin calling up again, just above 37,000. Look to be forming maybe a bit of a triangle formation here. Compression of volatility that could break up again with the next big resistance zone up at this $40,000 level. Another little bit of a bounce back in commodities as a whole, with gold still hovering just under that huge all-time high resistance zone at $19.80 an ounce. Uranium continues to be one of the strongest performing commodities this year, breaking out to new highs again. And that too looks to be walking the line in a strong bullish momentum pattern. And further breakout in orange juice and lumber futures trading up as well. Over to stock sectors, the loser today was cannabis shares, down 3.9%. We also saw a bit of weakness in the defensive sectors, staples finishing down, along with utilities and dividend paying stocks. And the top 3 winning sectors, ARC Innovation with overvalued high beta stocks, meme stocks at 2.6%, and then the third best performing sector today, IPO stocks. So the really kind of high beta sensitive stuff is performing well, kind of bit of a growth rotation out of the defensive low volatility stuff, and the BlackRock barometer continuing to walk the line as well. Really strong price action and bounce over the last couple of weeks. There's Tesla calling up right around its 50-day, and Meta also breaking out to new year-to-date highs, with some other former leaders this year, Supermicro Computer starting to perk back up. And there's Coinbase also trading really well on the back of strong crypto prices. And there's the price of Gap defending its earnings gap higher from Friday. There's the price of Alibaba looking to hold ground here, along with new highs again in Intel up over 2%, and General Motors may have put in a bottom here a week and a half ago on these strong bullish divergences. Stock's been really beaten down the last couple of months and has continued rip higher in Macy's. Seen some of these big violent moves on volume the last couple of weeks. And another breakout in the telecoms, AT&T and Verizon continuing to do well after their last earnings, with some mixed price action in the regional banks and big guys today. Okay, back to the S&P 500 for my final thoughts. Like I said last week, there's a lot of bullish momentum in this market. We were calling up here. There's been a lot of reasons for the bulls to get excited. My indicators are not showing much in the way of divergences. They look to be into this overbought zone where they can kind of stay there for a while. And like I said, we're just 60 points away from new year-to-date highs in the S&P 500, and the NASDAQ actually made new year-to-date highs today. And the big one will be tomorrow with Nvidia earnings, so make sure you come back for that. I'll give you all my analysis and thoughts on that and the market's reaction in the post-market. Otherwise, that's all I've got for you today. Thanks very much for tuning in. And if you're looking to get yourself a great deal on a new trading tool, head on over to my website, clickcapital.io, click on the big red banner, and you can check out these 7 different trading tools I use myself and often throughout these videos. And like I said, you just got to visit them through clicking these blue buttons on my website, as we've partnered with these companies as an affiliate, and what they'll do is share a small portion of your purchase with us as an affiliate commission, and then whatever you spend with these companies, you'll get the same amount in credit to use on my products and services from my website, however you see fit. So you can just pick and choose what products and services of mine you want for free, up to the value of your purchase. And these trading tools, you just have to go through these buttons for the first time and create a new account. And like I said, this is the best time to buy trading tools. And for a lot of people, you can claim this as a tax expense. And so if you're serious about trading and investing, stop using free tools and upgrade to the paid stuff, and you won't regret it. And some of these tools are offering huge discounts this week as well, like TradingView with 70% off. So if you don't already have a paid TradingView account, I highly recommend you get one. Stop using the free version with ads and just pay a little bit money. You'll get a much better experience. You get to add 25 indicators to your chart, a lot more alerts, a lot more tools and features. Plus you'll get the same value in free indicators from me. So this deal's for this week only. Head on over to my website, clickcapital.io, to learn more about that one. And I'll see all you guys again tomorrow afternoon. Cheers.